You're going to be happy you clicked on this video because we just got some market data that is incredibly astonishing. The payroll correction for the amount of jobs that was initially reported for economic growth was missed by over 800,000 jobs. Check this clip right here.
U.S. payrolls were revised lower by 818,000 jobs for the year ending March 2024. The figure came in on the upper end of economist estimates. The fresh data also comes ahead of an expected rate cut this fall. And it could fuel more uncertainty about the health of the labor market, and Americans themselves are seeing their own job prospects potentially decline. 70% of employees are bracing for layoffs, according to a MarketWatch survey. And so if you're part of that majority, we're breaking down how you should prepare for potential unemployments. To discuss, let's bring in Blair Duquesne.
And even in light of this, we still have the market that actually finished in the green today. And in the last 10 market sessions, we've seen 9 out of 10 finishing in the green. One of the big things that we did have was the market actually, and from the Fed, released the July meeting minutes. And this has basically boosted the probability of the first rate cut in September to be about 100%. You can see here what we've seen reported is that the moves from the September policy meeting here, these are going to be increasingly likely according to the minutes from the July gathering released Wednesday afternoon. Now, the majority of the participants in these meeting minutes, now they had indicated that loosening the monetary policy would be appropriate if data continued to come in as expected. And with the revision of the payroll jobs that was missed by over 800,000 initially, this really does bolster the expectations of the market participants, with traders now pricing in 100% chance of a rate cut next month. Now, this is per the CME Group's Fed Watch tool, where Wall Street diverges and really talking about how big this potential reduction will be. Right now, we see analysts and investors that are predicting from a 0.25% up to a 50 basis point rate cut for the first one. Now, one of the big questions is it too late? And what are the different key advantages that investors can take to get on top of a rate cut? And where will the money be flowing into? One of the biggest predictions that we've seen in the recent futures is the small cap stocks. And this is because as rates actually do cut, borrowing becomes cheaper for the same amount of money. And smaller cap stocks usually benefit from this type of situation. On top of that, you have large stocks and big AI stocks within the Magnificent Seven that have really grown, just looking at NVIDIA, within the last year. You can see market capitalization that will eventually trickle into what everybody's really kind of focusing on right now. That is the IWN, the iShares Russell. And what we've seen for U.S. fund flows, and just looking at some of these metrics here, is the amount of cash flow that is pulling into these ETFs. You can see here U.S. funds collected $83 billion in July, the second strongest month of the year so far, despite the market volatility that we've seen. And with this being said, we are also continuing to see a large rebound in the correction that we got in the beginning of August. So on top of this, one of the big things for a high risk potential that still is in the air that we cannot disregard is the chance of a recession. We see small caps that are continuing to stand out even though we have this high risk that is still ahead of us. The U.S. equity funds, they gained $20 billion in July, making their 4th month of inflows so far in 2024. In talking about specifically iShares Russell, right here what we talked about, the iShares Russell 2000 ETF, the amount of inflows is increasingly starting to build within the stocks within this ETF. And what we've specifically seen, and a lot of analysts have came out to say that a lot of the stocks within this ETF are actually undervalued. And it's interesting to see here, you can see it's closing in at $215, up another 1.3% today. Every time we see that basically have the media reporting that we see an increase in the probability that these interest rate cuts are likely going to occur, which is now at 100%, we see the iShares Russell that does grow. I think as this continues, and even with a rate cut cycle that is predicted to happen within the market, we could see this ETF that continues to accumulate in its value. What does that mean for other stocks that we've talked about on the channel? One of the big things that, of course, that we've talked about is Palantir Technologies. Now, of course, Palantir specifically, I like Palantir. We talk about this all the time due to the fact that this is still an early AI stock with the amount of potential that it does have within the AI boom. We've seen things like NVIDIA that have absolutely soared throughout 2023 and even now throughout the majority of 2024. Palantir has reported great quarter results and has now continued looking at the Rule of 40 metric, continued to improve upon itself quarter after quarter. And you see basically consolidating right here and holding above the 30s is incredibly important considering on a technical basis, Palantir Technologies had a lot of resistance at that $30 mark. And what we've seen and why I'm continuing to stay bullish on Palantir is because of the massive opportunity that we're seeing in artificial intelligence across the board. Like I've said, we see huge companies, NVIDIA, Microsoft, Alphabet, Meta, all these big stocks really diving and getting their feet wet with artificial intelligence. Palantir is bringing a strong utility case factor to the different clients that it is continuing to diversify itself by not just sticking with the governmental side of things, which is where Palantir really gained a lot of credibility. We're now seeing that diversification into the commercial segment. And one thing that I really like seeing here for the next quarter earnings, I know earnings just came out, so why are we talking about 3 months on the line, is the earnings per share revisions in the last 90 days is already 11 in the bullish direction. This means that we are seeing Palantir and even analysts on Wall Street that is continuing to improve upon their prediction and what they expect Palantir to set in terms of actual earnings reports and what's going to be reported on the balance sheet. One of the big earnings that is coming in the near future is going to be NVIDIA. And while NVIDIA has still really grown and has exploded, we've seen its explosion with the AI boom, I still think there's room to run. And I agree with a lot of the analysts that still say NVIDIA can hit $130, $140, $150 no problem. You see here the AI boom in terms of what's predicted to happen within the next decade just gives you a little bit of a glimpse of how high NVIDIA could go along with the other AI stocks. In terms of how with the interest rate cuts being affected in here, that is where the risk still lies in terms of will this rate cut lead to a soft landing in the economy rather than a hard landing and we see a large correction within the market. Of course, one of the best tactics that we hear from a lot of people out there in the world is DCA, dollar cost average, and even to dollar cost average more aggressively if we do see any type of correction within the market. Now, of course, a stock at a cheaper price may seem uncertain and bring fear and emotion to investors that might have too many eggs in one basket. However, personally, I see it as an opportunity to basically get these stocks on sale. And dollar cost averaging can be a very powerful tool to continue to bring your average share price for whichever stocks or ETFs you hold back to more of a bang for your buck. And with NVIDIA going back here for earnings, reports results, they're still expecting exceeding guidance while projecting even higher revenue in the October quarter. So nonetheless, if we see any changes in valuation and market capitalization of these big stocks, looking at what's been actually happening, these AI stocks are still continuing to soar and doing well, just kind of not regardless of their stock price. I'm talking about what's actually being reported in the earnings. This is what's driving the valuation and the premium that's currently being paid right now. So with the economic activity and the change in payroll, I want to know, what are your guys' thoughts on what could be happening here within the next few months, especially with the Fed rate that is predicted now at 100% to actually decrease the interest rate? Do you think that a soft landing is still achievable, or do you think the risk is too high and the Fed is too late and there might be a harder or a stronger correction than what we once thought before? Peace out, take care, and I'll catch you guys later.